Today I wanted to post an update of my video on what is an asset. So I'm going to kind of use a personal example of something that me and my wife go through when it comes to assets. Excuse me. So we're going in this video. What we're going to do is we're going to suppose for a moment we have $7,000, and me and my wife is sitting down and we're making a decision on purchasing a new asset. She wants, on her side, she wants a new Cartier bracelet. On my side, I prefer $7,000 in BlackRock stock. So, are they both assets? Yes. Do they both have the opportunity to appreciate? Yes. Do they both have an opportunity to decline in price? Yes, they do. Do they both going to kick off free cash flow? No, they're not. BlackRock has a dividend of about 3% right now. And I'm not advocating for BlackRock. BlackRock is one of my favorite stocks that I own, but this is about $700 a share. Last week on the 14th, they were on April 14th, they reported earnings, and they reported earnings that were down year over year, but they outbeat expectations. So the stock was up pretty good yesterday, and so the stock is around $700 a share. So I wouldn't be buying BlackRock right now, and I would hope to have an entry price at a lower date. But it's just, and that's not what I'm comparing right now. And is between buying it, even at $700, which I could buy 10 shares, as compared to buying a Cartier bracelet. So let's say if my wife wins and she wins over the asset of buying a new $7,000 Cartier bracelet. Do I believe that a Cartier bracelet is going to appreciate? No, I don't believe so. Maybe 20 years from now, 30 years from now, when Cartier bracelets with inflation, Cartier bracelets are selling for $12,000. I mean, you might be able to sell the Cartier bracelet for $10,000. And would you have some appreciation? Yes, you have, $3,000 in appreciation, so a little less than 50% over a 20-year percent. That, to me, that's not a very good return. And how I came up with $10,000 is right now, you can go on eBay, you can go a couple different sites, and you can buy used Cartier bracelets for around $5,000. Now, with the Cartier bracelet, my wife would be able to walk around, and people will be able to see, oh, that's a Cartier bracelet, right? She has a couple Cartier bracelets. Wow, she must be doing pretty good. So there's some value in that if that's what you value. I happen to not value that. I'm just fine knowing that I have 10 more shares of BlackRock that's $7,000, that cost me $7,000, that's paying me a 3% dividend. So on $7,000 a year, I'm probably getting about, let's just say $180 a year that's being added. So as compared to make the math easy, let's say I'm getting $200. So in a 10-year period of owning my 7,000 shares, I'm going to get at least $2,000 in dividends. So in a 20-year period, I'm going to get at least $4,000 in dividend, and I'm still going to have my BlackRock shares that I paid $7,000. So now I got, in the 20 years that my wife had the Cartier bracelet, it didn't kick off no cash flow, and we believe that it may be worth $10,000. So with my BlackRock shares, as I say, if I got $200 a share off the $7,000, it'd be a little bit lower, but for easy math, we're saying $200. So we know now in a 10-year period, I would have gotten $2,000. In a 20-year period, I would have gotten another $2,000. So that's $4,000. So now I have my shares, and I know I got $4,000. So that put me at $11,000 in a 20-year period, which is now $1,000 over the Cartier bracelet. Now, no one knows we own our BlackRock shares. Everybody knows she has a Cartier, well, everybody that sees her knows she has a Cartier bracelet. So included in that, if I had to guess, now I believe BlackRock is a really good company. I may be wrong, but I believe BlackRock is a really good company. If you don't know, you may want to go do some research on it. But one of their main products is the S&P index, the SPY. The SPY, I don't believe in 20 years, we can almost get hit with a nuclear bomb, and I believe the SPY will still be trading. So I believe in the long-term growth or long-term business of BlackRock. Is their dividend going to stay at a 3%, not even including the fluctuations? Are they going to increase their dividend over a 20-year period? Yes, I believe they do, because I believe they're going to grow their earnings and they're going to return more capital to shareholders. I believe they're going to buy shares. So, and I actually believe, I mean, I have no idea, but it ain't no way my $7,000 in shares, $7,000 in shares, my 10 shares, I don't believe they're going to depreciate much over a 20-year period. And I believe they're going to significantly gain over a 20-year period. And if I had to guess, it could be easily up 200%. Between them buying back stock and them growing their earnings, I could believe it could be up 200%. Which saying that my $7,000 now may be worth $21,000. So now, just a guess, over 20 years, could be higher, could be lower, but that's just a guess that I think could happen, could easily happen. So now not only did I get a $4,000, which more than likely I'm going to get a higher dividend in return because they're going to increase their dividend. But if they kept it the same, I get $4,000. I believe I'm going to get an appreciation in stock over a 20-year period. And I'm saying my $7,000 investment could be at $21,000. So I'm saying over a 20-year period, my wife's Cartier bracelet may be worth $10,000. But I believe my BlackRock shares is going to be worth $25,000. But again, this is my wife. She really wants her Cartier bracelet. So if I had to guess, she's going to get her Cartier bracelet, and I'm also going to get more shares of BlackRock. But what I wanted to try to do is just make an example of the difference in two different assets. One that you can wear around, people may be impressed with. Another, no one knows you got it, and it may appreciate. So you have to decide for yourself which one, is important to you. No one can make that decision, but this is an example on allocating capital in two different type of assets.